Hello, everyone. This is Jelena Ogilvie with Principal Wealth Partners, and this is a fixed income update for May of 2020. Today, I would like to talk about three things. First, the bond market today as it relates to past environments. Second, what has been done by the Federal Reserve to stabilize the markets. And third, the trade-off of owning different asset classes. Let's first review where we've been by looking at the history of the 10-year Treasury, which is shown here in blue. In 1981, the 10-year peaked just shy of 16%, and for the last 29 years has seen an extended bull market as rates moved lower, ending where they are today at an unprecedented low of below 1%. Bond market prices, as a reminder, move higher as rates go down because those existing bonds have higher yields, making them more attractive. With rates as low as they are today, there is a natural concern of what to expect of the return in bond prices going forward when these rates start to rise off of these current low levels. And just as we've noted the volatility in the stock market this year, it has been no different in bonds. You can see on this slide, going back to March, the dispersion of all the fixed income asset classes. This unanchoring began with a supply-demand imbalance that fed into growing uncertainty in the markets. As you can see from the light blue at the top of the page, treasuries moved higher this year as rates simultaneously fell. As treasuries are backed by the full faith and credit of the US government, they historically tend to perform well when other areas of your portfolio, such as equities, do not. Other areas, such as below investment grade corporate bonds and sovereign debt that tend to move more in line with equities, lost value. In fact, within all of the fixed income sectors shown here, there has been over a 20% variance in returns so far this year between the winners and losers in the bond market. These dislocations, of course, raise the question of where we might find opportunities within fixed income going forward. As we've talked about, the policymakers went into overdrive to stabilize the markets, including fixed income. This slide shows the history of our federal funds rate. As you can see, after years of essentially being at zero, the Fed back in 2015 started to methodically raise rates. On February 28th, Chairman Jerome Powell committed the Fed to using its tools to support the economy and quickly lowered rates by 1.5% back to a range of 0 to 0.25%. They also restarted quantitative easing, or what's known as QE, and created a wide range of credit facilities for money market funds, primary dealers, commercial paper, and even enhancing swap facilities with other central banks. If you look further at the history of the Fed's balance sheet, you can see to the right of the dotted line, their forecast of QE is monumental relative to the past. In just under 8 weeks, QE4 took assets from 4.7 trillion to 6.7 trillion. To put this into perspective, with the first 3 rounds of QE following the crisis of 2008, the balance sheet went from under 1 trillion to 4.5 trillion. This current round has also expanded its purchases from treasuries and mortgage-backed securities to other areas, such as below investment grade corporate bonds. I once heard someone say that liquidity is like health. You don't appreciate it until you lose it. The ultimate goal was to ease liquidity issues, and since then, many companies such as Boeing, Southwest, and Hyatt Hotels have successfully gained access to financing. Finally, the markets offer a risk trade-off that is important to understand. Starting on the left in cash, it shows you receive little income in cash, but you're compensated with low risk. As you move up the curve, you increase your risk, but are compensated for more income in areas such as corporate bonds and emerging market debt. The right-hand side shows that as you move towards equities, you further increase your risk, but you lose your income. That is because you are now compensated with a higher total return. Finding this balance of return versus income versus risk are all considerations in how we invest your portfolio at Principal Wealth Partners. In summary, there are many considerations to keep in mind in the bond market, from downgrades to defaults to a huge issuance of debt. Historically, we have benefited on appreciation from bonds, from rates moving lower, and from diversifying from the uncertainties of the equity market. Although the latter still holds true, we must look going forward not for the appreciation from lower rates, but rather from dislocations in the market and where we see opportunity from this. As always, please reach out to any of us at Principal Wealth Partners if you have any questions or would like to discuss this further. And thanks for listening.